Hello, Capital Region. This is Dayton Maxwell, Farm Business Management Educator with the Capital Area Agriculture and Horticulture Program. This week, I wrote about income tax management because it's that time of year, and most of you reading and watching will have probably already worked on this earlier, probably in October, November, maybe even September. You're thinking about income tax management. But just since we're getting close to the end of the year, I thought I'd bring it up. Since farms, because of rebounding markets and also because of government assistance, are tending to have a good amount of money on the farm. So how do you manage income taxes? One of the important things to remember is we don't want to eliminate income tax entirely because profitable businesses pay income tax. And you want to be able to show your lender a tax return that demonstrates that your farm or agricultural business made money. So we're managing versus eliminating. Some ways to do this. Prepaid expenses. All right. So what you can do is prepay for some operating expenses this year that you will incur next year. So common examples are feed, seed, fertilizer, things like that. So again, farmers will pay for them at the end of this year, 2020, and use them in 2021. Prepaid expenses cannot exceed 50% of regular deductible expenses. All right, might make some capital purchases. I love this one because I hear people say all the time, oh, my accountant said I got to spend some money at the end of the year. I got to buy something. And what that person is talking about is making a capital purchase, typically machinery, and reinvesting in the business that way. And what we're able to do in that situation is depreciate rapidly that asset. There's a depreciation rule called Section 179, and for 2020, the maximum Section 179 deductible allowance in the year of purchase and place in service is $1 million. So technically, you could buy $1 million piece of equipment on December 30th, place it in service on December 31st, and expense that full $1 million. Now that's a serious way to manage income tax liability and reinvest in your business at the same time. The next one, deferred income, may be an option. It's kind of rare, but sometimes the business entity that you're selling to will be willing to hold income back, and so you can reduce income that way. Just an example there is in 2014, some dairy cooperatives were willing to hold the 12th check back and pay the farmers that money in 2015 rather than in December of 2014. All right, not common, but possible. Income averaging is a situation where if we have a really high income year, like 2020, we can take that and average it back to the previous 3 income tax years. If those years were lower in income, it might make sense to do that. Talk to your accountant. This isn't a big deal. Have to amend those other tax returns, but your accountant should be able to do that in a jiffy, right? And as we go down through capital leases, leases are not as popular as they used to be because of low interest rates. However, sometimes you can get a lease at the end of the year that has an upfront really big balloon payment. You can pay that at the end of the year and expense that directly from your income taxes. And typically leases are for equipment and sometimes buildings. The nice thing about leases is you can directly expense the payments on your tax return. All right, so in summary, which one is best? I would say depends on the financial condition of your business. If your business historically struggles meeting 12-month obligations or 12-month operating expenses, in my professional opinion, investing in prepaid expenses is a really good idea because it creates business liquidity, and liquidity is the foundation through which all business operations are funded. So invest there first. If you're in a better financial position, you may consider a capital purchase. I caution you to choose your capital purchase wisely with the idea that does this capital purchase grow my income stream or create efficiency so I can reduce my costs. You may not want to purchase something that just sits 9 or 10 months a year and really doesn't grow your income stream or reduce your costs, although it may make you more comfortable. I understand that too. So that's what I'd say. Smart capital purchases, prepaid expenses are really good. If your business has tremendous earnings, has tremendously strong financial position, then heck, do whatever you want. Buy something new just because you can and enjoy it. All right, have a good weekend. As always, it's my pleasure to serve you. Please call me. We'll talk about farm business management. 518-380-1498. My email is dtm4@cornell.edu.